Definition of central bank's role in inflation. Central banks, such as the Federal Reserve in the U.S., manage inflation by adjusting monetary policies, primarily through the control of interest rates and the money supply, to stabilize the economy. Influence of interest rates on inflation. One of the primary tools central banks use to control inflation is adjusting interest rates. Raising interest rates makes borrowing more expensive, reducing consumer spending and investment, which can lower inflation. Control of money supply. Central banks regulate the money supply by buying or selling government securities. Reducing the money supply through selling bonds can curb inflation by decreasing the amount of money circulating in the economy. Inflation targeting strategy. Central banks often set an inflation target to maintain price stability. They use their tools to ensure that inflation stays within a range that promotes economic growth without overheating the economy. Use of open market operations. Central banks engage in open market operations, buying or selling government bonds to influence short-term interest rates and control inflation. By doing so, they aim to manage liquidity and stabilize prices. Lender of last resort role. In times of economic distress, central banks can step in as lenders of last resort, providing liquidity to banks and financial institutions to prevent inflation from spiraling due to economic instability. Impact on consumer and business behavior. When central banks raise interest rates to fight inflation, borrowing becomes more expensive for consumers and businesses, reducing spending and investment, which helps bring down inflationary pressures. Balancing economic growth and inflation. Central banks must strike a balance between controlling inflation and promoting economic growth. Tightening monetary policy too much can lead to a slowdown in economic activity, while too little control can lead to runaway inflation. Communication and expectations management. Central banks manage inflation expectations through communication. By signaling future policy moves, they influence consumer and business expectations, which can help prevent excessive price increases. Long-term inflation control. Central banks aim for long-term price stability by maintaining policies that control inflation rates in the long run. Their actions ensure sustainable economic conditions, reducing the risks of both inflation and deflation.